Welcome to the panel. We're very excited to be talking about a pretty ambitious topic, I have to say. It's exciting to talk about market structure. And as was mentioned, the title is the crypto market structure, liquidity, arbitrage, and security. And we're going to get into some really exciting themes across best execution. We'll be talking about clearing and settlement. We'll be talking about certain different kinds of risk that we see in the market structure. And of course, we'll get into kind of a variety of subgenres within the market structure, which we're all quite excited and interested about. So my name is David Easthope, and I head up the digital assets research function within Coalition Greenwich. And very excited to be joined by four extremely knowledgeable panelists who can really tell us the ins and outs of the market structure. And before we kind of jump into the conversation, I think it's a great chance just to introduce yourselves and your firm and let us know what you're working on. Why don't we start with Glenn?
Thanks, David. Also want to say thank you to Blockworks for having us here. My name is Glenn Barber. I head up sales and business development at Copper here in the Americas, which is a global digital asset custodian.
My name is Judika Chow. I run our OTC options trading at Kraken.
Hi, I'm Jenna Wright, the Managing Director of LMAX Digital. We are a cryptocurrency exchange built for institutions operated by LMAX Group, who have traditionally run foreign exchange venues for the last 12 years.
My name is Chuck Lugay. I'm head of execution services at SFOX. SFOX is an institutional trading platform that was built from the ground up for institutional traders. Our goal is to achieve best execution within the spot crypto market. And I'd like to thank Blockworks as well to have us here.
Excellent, thanks, Chuck.
Yeah.
So as we were getting sort of organized around this panel, one of the themes that we thought of was about not only making these markets safer and better for the crypto native firms, but also for traditional firms, for real money players. And sort of we have that in sort of the back of our mind as we approach these questions here. But I think probably best to define things up front so everyone knows what we're talking about. So maybe Chuck, if you can just give us a range of kind of the scope of assets when we talk about market structure, as a prime dealer, how are you thinking about different asset classes and kind of define the landscape for us?
Sure.
Could you start us off?
Absolutely. So the focus from SFOX's point of view, we really concentrate on the spot crypto market, right? And what we've tried to do in terms of the platform itself is to bring some kind of semblance to the best execution environment you see in from the traditional finance markets. So my history prior to coming into digital was 20 plus years in electronic market making, both equities and options. So when I came over, I saw a lot of similarities, but they were kind of like similarities from back in the early 2000s, late 90s. So there's a lot of, I'm sure there's going to be a lot of evolution going forward. Really, like I mentioned before, our goal is to focus on best execution, and within the space though, it's a challenge, right? Because the fragmentation within the spot crypto market is immense. You're talking about almost 600 different liquidity providers across domestic exchanges, international exchanges, market makers, and to be able to access the best price within that ecosystem is a challenge. What SFOX has attempted to do is aggregate some of the most liquidity providers out there, and in so doing, creating a kind of de facto NBBO, so something that allows traders coming over from TradFi a certain level of comfort within that space, and that's what we're hoping to do, not just in spot crypto, but eventually later this year, beginning of next year, in options as well.
Excellent. And Judika, the market obviously includes more than just spot, right? We have derivatives, variety of products, options, futures, NDFs. Maybe you can talk a little bit about how derivatives are different in terms of the market structure and what you're focusing on.
Yeah, so derivatives by nomenclature and name derive their value from the underlying. And there's a number of different types of derivatives and reasons that people trade them. I think the few top ones in crypto are first, not having to necessarily deal with custody and cold storage. So if you can get exposure via a swap or a non-deliverable forward, that might be preferable both to institutions as well as high net worth individual retail investors. Another reason why people might trade them is sometimes derivatives are a little more conducive to leverage and margin. So options which is what I focus on, has natural leverage. But also linear products like perps and futures are sometimes a little bit easier margined than something like a spot product. Even though you can margin spot, you can mechanically do it a little bit differently with perps. And then the last reason is regulatory. There are some institutions that just can't touch crypto for regulatory reasons, or there's some reasons why in different jurisdictions, derivatives are more accessible than spot, even when mechanically they can be very similar. And so for a number of reasons, people will trade the derivatives instead of trading the spot. I think over time, we'll start to see a little bit more price discovery in the derivatives markets. So far, probably we've only really seen it in the linear products where sometimes the perps and the futures will lead spot, especially overseas. But especially as institutions get more, start to put on larger positions in options, in non-deliverable forwards, those will filter into the spot market in the future. And so derivatives will play a big part in the market structure.
Jenna, I know that you have some additional thoughts on derivatives and some initiatives there that you wanted to discuss.
Yeah, so I guess similarly to Chuck, we've focused on spot crypto for the last 5 years. But you have to listen to your clients, and from the FX world where a lot of our clients will trade crypto, some of them we haven't been able to have trade crypto. So we have 35 of the biggest banks in the world trading foreign exchange, but a challenge for them is regulation. They're not allowed to trade physical. So, for us to offer them a full product or services, we've moved into listed derivatives, namely like a monthly and a quarterly future, because we know they want to trade the cash product, but whilst there's no regulatory clarity on that, it makes sense for us to offer a cash settled derivative, which we've partnered with a large group, 6 group, CCP. It will have a lot of characteristics that they are used to with the traditional futures products that they're used to trading. And then they get their exposure to crypto that they can't have by physically trading the spot offering.
I think what I've heard so far, and certainly worth pointing out, is some of the unique and special differences that there's bearer assets. There are banks that can't touch a lot of crypto. There's an absence of kind of traditional prime brokers, prime services, and you mentioned kind of favoritism towards products that are sort of more understood, more integrated into the organizations. I think, Glenn, one other topic that definitely comes up is the difference between firms that happen to be onshore or offshore, and choice of legal entity is something that often comes up. I know you had some insightful thoughts on that as well.
Sure. I'm going to guess it's common knowledge, but U.S. investors, particularly on the institutional side, are severely disadvantaged. Certainly if you play by the rules that are sort of moderately set out. We have maybe 10, 15, 17% of global volume, I would guess, but most liquidity is offshore. And so if you have a US domiciled fund and you're an SEC registered investor and you're looking to get into digital assets, right, it is a more complicated legal and compliance exercise to decide whether or not you are going to stick with traditional onshore US exchanges that make themselves available in a regulated fashion, at least according to the United States, or whether you're going to be able to go offshore and take advantage of a lot more products, a lot more liquidity, and basically get better execution. Right? And I think that anyone that is involved in this market knows that. I think this is where a lot of the spot versus derivatives conversations come up, right? Because I think, look, if you're in the capital markets business, there's going to be a normal evolution, right? And I don't know if it was Jithica or anyone else that brought it up, but you take a U.S. bank. A U.S. bank, because of their capital controls, the regulatory status as a bank or a federally regulated entity, probably can't hold crypto on its balance sheet, right? So what's the first thing they're going to go into? Probably a swap with some CFTC regulated dealer that then potentially backs to back with an offshore entity that has liquidity, can do the hedges, and then bring it back onshore. So just a typical example that crypto, once again, as you've probably heard numerous times, very early stages, very large dichotomy for US investors versus what you can find offshore, but progress is being made, and investors seeking returns will help be part of that progress.
So we see a lot of variety of product. We see a variety of approaches to liquidity, somewhat of a fragmented market in terms of exchanges. So Chuck, that must lead to a lot of different ARB strategies that people can employ. And so maybe talk a little bit about arbitrage and what are some of the opportunities that people are pursuing out there.
Sure. Well, I think the platform that SFOX has deployed lends itself to accessing arbitrage opportunities simply by having those multiple pools of liquidity on one platform, and invariably you're going to have inefficiencies in pricing. It's all right there for the taking. So yes, I mean we have people who trade on the platform that can easily benefit from some of those arbitrage opportunities. There are some clients who are sophisticated enough that can build bots to systematically seek out those arbitrage opportunities. So that in and of itself shows that the benefits of having some kind of access to an aggregated pool of some sort, at the end of the day, it really does lend to achieving more alpha in some of those trading strategies out there.
Yeah. And Jyotika, from the derivatives side, how does your platform, how do you ensure that you have consistent liquidity, deep liquidity? How do you think about sort of the derivative side of the market?
Well, for us, we're OTC, and so we trade Kraken's balance sheet, so our liquidity comes from there. But for any OTC like market maker, it's important to have liquidity on exchange and through other OTC dealers to be able to hedge. And I think the liquidity there comes from probably two main pieces. One is capital efficiency, especially in the recent months when credit has really tightened. The more capital efficient that various venues can be, the more that contributes to liquidity. Just for like the same amount of collateral, if you can put on a larger position, you can have a more liquid market. And then I think the second for derivatives is the degree to which products are, I wouldn't say fully fungible, but at least easy to replicate. If you create a really complex product that's very difficult and expensive to hedge and replicate, then it's going to be really hard to build liquidity. So the more standardization and the more standardized products are in the derivative space, the more liquidity there is there as well.
Yeah. One of the things that certainly jumps out anytime you're looking at this space is the unique risks. And one of them is the fact that this is spot crypto tokens are bearer assets, and custody all of a sudden comes into the frame. And one of those things that can certainly make things facilitate trading better would be movement of assets among custodians. So Glenn, what do you think is the future of that? How can custodians work together to sort of avoid some of the pre-funding and other issues and challenges there are out in the marketplace?
Well, this will go a long way to the broader adoption of the market, right? I mean, let's face it, digital assets or crypto is a unique asset class where 100% of your transaction is at risk every single time. When you move it from one wallet to another, whether you fat finger a wallet address or you miss whitelist something, it is 100% at risk until the other proper wallet receives it. And if you screw something up, there is no recourse, right? There's no oopsie, that's a clearly erroneous trade. We can pull that back. We have T+2 settlement. We have custodians. We have clearing layers. That doesn't exist because blockchain technology is basically peer-to-peer, right? It's designed to eliminate a lot of the middlemen in those types of transactions. So that's number one, right? That then means that the usual investor protections that are layered into traditional asset classes that we're all sort of used to, equities, bonds, now foreign exchange to some degree, commodities, real estate, don't exist. So now you have to be careful, right? You got to pick your custodians very carefully. You have to understand how to orchestrate your transactions in the safest way possible. And then, sort of the holy grail of liquidity and movement of assets will be intracustodial transfers, right? If you go into the normal world or the traditional world, right, we all know that State Street, Boney, Northern Trust, JP Morgan, Citigroup, they all have intracustodial transfers. It's usually orchestrated in the equity market by DTC on sort of net bilateral settlement at the end of the day, which is the only reason that any one stock trade settled in the first place, right? Crypto hasn't gotten there yet. People like Copper and other custodians are very much thinking about it because if you look at the hedge fund world in traditional finance, most people have multi-primes, right? I'm unfortunately a person who's already been through the Lehman Brothers bankruptcy, so I know a little bit too much about that. But the bottom line is you have a prime at Goldman, you have a prime at Morgan, you have a prime at Merrill, right? All this stuff matters. That doesn't happen in crypto because the natural market evolution hasn't gotten there yet. Once again, because digital assets are still fairly early. We at Copper are working on it. Other custodians will probably agree with me. And the nice part is that as we build all of our businesses, for all of you people here in the room, that will then provide adoption, because the typical market strategy is, look, my stuff goes to Boney or my stuff goes to State Street. Make it happen. If you can't make it happen, don't trade with me.
And we had this conversation just now, right? Glenn said, why is LMAX not connected to Clearloop yet? We're getting there, and that has to be part of the bigger ecosystem. You know, as an execution venue, LMAX Digital, we're very good at matching buyers and sellers, and that's what we want to do. But we also want to be able to facilitate the client saying, give up my trade to Custody X, Copper, whoever it may be. And I think we're getting there, but it's slow. Real money entering the space is slower than we might have liked. But if ever there is a time to build, it's right now, when this year markets are a little slower than they were last year. So yeah, preparing for the next bull run, getting ready to take on what's coming at us is really good timing to start integrating to other custodians, you know, potentially even other trading venues.
You mentioned the real money players again. Thanks for doing that, because if you've been trading other assets and you're moving into crypto, you're used to some of these advanced execution technologies, algo trading. You've got different hardware, software, ultra low latency solutions. Now in crypto, we're not there yet. We're working on it, but maybe you can talk a little bit about some of those techniques and improvements that you're seeing out there in the market, Jenna, that you brought.
Yeah, sure. So LMAX Digital actually was born on the back of FX client demand. So a ton of our, let's say, high frequency market maker type clients were starting to take big positions in crypto. They were market making on a lot of crypto retail exchanges, and they like to typically be delta neutral and be flat. So they were going out there to the market, looking to get out of positions, risk reduce. And I'm talking about 2017. Exchanges went down for hours and days, and that just wasn't acceptable. So approaching us, asking us to do what we do in FX, when we looked at it, you know, Bitcoin dollar, Ethereum dollar very much looks like Euro dollar and dollar yen. It was the same software. We just span up our 5th exchange at the time, used new hardware to get LMAX Digital out the door. Obviously, there was a few more complexities, such as custody, which we hadn't had to worry about before when we relied on banks. But institutional grade infrastructure, high throughput, low latency matching engines, that enables consistent and reliable performance. And exchanges can't go down. You know that, right? And when you're aggregating liquidity and trying to get execution in volatile periods, the exchanges can't go down. Like, it's essential. So what has been tough though, when we speak to the crypto native clients, they want REST APIs and WebSockets. And getting my CTO to build me those has been pretty tough over the last few years, because, you know, we talk about fixed protocols, we talk about itch and ouch, not missing a price update or a price tick. That's what we're used to in TradFi, and then just had to step it back a little bit. But I think that just goes in line with, we're in a nascent asset class. Things are moving slowly, but it's still so small. Market cap's tiny. We can't really compare it to the type of asset classes that we've been trading over the years. But, you know, we're getting there, and I think everyone has to move towards that institutional grade technology.
Yeah, just to echo that a little bit, I think that, you know, you say that exchanges can't go down, but they do, right? I mean, we see it all the time. Even before I got into this space, trading my personal account, you know, I'm not going to name names in terms of exchanges, but I could count numerous times where I've gone on to try to do something, either buy or sell, and oops, it's not accessible. So you know, one of the ways that we've tried to address that on our platform is having access to multiple venues at one time. So if one goes down, you still have access to 35 others, right? But you know, that's part of the maturation of the space, and it's going to get better. I mean, you bring up REST and WebSocket. You know, right now, I think that, you know, from new clients that we've seen over the past year, the vast majority are adopting fixed protocol, which is, in my opinion, a much better protocol to use from an execution standpoint. You know, that might be just from the background that I'm coming from.
No,
but,
I mean,
you know,
it's sad, but you get excited when the first thing people
Right.
ask for is a fixed spec
right,
versus
right,
they want a REST API. Oh dear. It's just not the future.
right. Yeah, I certainly agree with you on that. So.
You certainly see more fixed protocol, that's for sure. I love that sort of institutional grade concept because it seems like it's a rising tide. You see that on the trading side, but you also see it on the news side. Data is now being delivered. There's more user-friendly terminal-like experiences out there for traders and some of the real money players who are starting to think about this. Juthika, what are you seeing just in your world in terms of some of these like next generation technologies?
Well, I think one of the like kind of innovations that we see at the exchange level is sort of born out of necessity, which is kind of integrating the clearing system into the matching engine, which didn't really exist in the traditional world where everything is segregated and exchange just matches trades, and then you have the clearing side which clears afterwards. But here in crypto, everything has just been vertically integrated at a lot of these exchanges, and so because of that, you've had to make a lot of innovations to actually have decently functioning matching engines that are also doing the real-time clearing and margining and liquidations. And so I think that's been like a really interesting innovation that we'll see if that makes its way, back into TradFi or how that goes. But that's been an area that I think all exchanges continue to innovate on. And to me, it's kind of interesting from a market structure point of view.
Yeah, on the matching side, we obviously saw the announcement of the new exchange. They'll be using the LMAX technology. So it's interesting. I go back to maybe 10, 12 years ago, the rise of ECNs and dark pools and equities, and now these worlds are kind of converging, and some of the technology built for that is now potentially going to get repurposed in crypto. Glenn, you brought up the vertical integration and exchanges. That brings up one of our favorite topics, counterparty risk. Some of the issues that exist today, right? In the future, maybe we don't worry so much about that, but in the world we live in today, we have it. So maybe you can talk about some of the risks out there in terms of both technology risk, counterparty risk. We just had a whole panel that addressed Three Arrows Capital, but I think we need to address this as well.
Yeah, look, there's more risk in digital assets than there is in any other asset class. It's just that simple. As I said, you've already heard me say that 100% of your notional is at risk every single time it moves, and that's just the reality of the situation. Counterparty risk cannot be underestimated. It's out there, and it is prevalent, and it is day to day. And we were just talking about this in the back room as well. I don't want to diverge, but along with counterparty risk comes better business practices and risk management, which obviously crypto didn't do a really good job of over the past 3 or 4 months, and certainly in the months leading up to it. But I think the exchange you mentioned, EDX, is really interesting. And I think Juthika also made the point about vertical integration, right? So what happens after that? Okay, so you've got a couple of great firms. You've got Citadel, you've got Virtu, you've got TD and Fidelity and a whole bunch of people saying, what the United States needs is a really cool exchange that's actually there for the investors, not for the exchange itself. And we're going to bring crypto adoption in one fell swoop because we are a consortium of major players that have really good brand name recognition, right? Makes perfect sense. Okay, so then the next conversation would be, at least from my perspective, and I am a little bit biased because of the business I run here at Copper, is what are you going to do? You're going to pair off your trades. Where are they going to drop to, right? How are you going to clear? How are you going to settle? And so the second level, third level conversations that need to be had is, and this is endemic to crypto, right? Because you have all of these really, really smart people globally, mostly technologists, mostly engineers, right? Not silly people like me, who deliver to market, but with a slightly more narrow focus. And what they don't necessarily pay enough attention to, at least in my opinion, is how do you broaden the adoption to a scale where your product delivery is one piece of a broader conversation. And so just to go back to the EDX reference, is like, okay, so how are we going to make this safer for everyone else, right? You're not going to be delivering your crypto into Northern Trust or State Street. You might be able to at some point by the end of the year. But what happens after the matching happens? What happens after you execute? Where does it go? Which wallet? Who's the provider, right? And I think obviously regulatory environment will come into this, but these are the things that we think about.
Yeah, I know Jenna, you think a lot about this topic as well. You're a counterparty. You think about different risks on the clearing and settlement side. What are your thoughts on the market structure in this area?
It's been quite scary to see that firms don't have risk management controls in place. I don't know if we take it for granted because we've been there, done, and have been doing that for a long time. But if anything, maybe it's going to filter out some annoyance in the industry. I think we're going to see a bit of government pressure now around regulation, which is key because it's a little unknown at the moment what ways we're going, in what jurisdictions, what are we regulating, who are we protecting, all these questions are unanswered. If we can answer those, then I think frameworks in jurisdictions can pop up and start to align, which is key, right? Because we are a UK hub, LMAX Group. Our crypto entity is regulated in Gibraltar because they have a DLT framework, and that's good for us. We would love the UK FCA to have a full-on crypto regulation. We're not there yet. MiCA's popped up, European regulation. Obviously, there's a ton going on in the US. Singapore's taking regulation quite seriously. We're looking at that. It's again, back to the whole ecosystem piece. We've got to build all these different parts of the ecosystem for us to move forward.
Yeah, and I think part of that also is intellectual capital, because a certain broker experienced a loss and then had changes in their organizational structure, and you saw some of the resumes of people that came into the organization after that effect, and you saw lots of risk management and hedge fund experience and not necessarily the crypto native. So you sort of see some of that talent, I think, on the risk side, who understand best practices, who understand how to do traditional risk management. I think you see some of those people starting to come in as well. So it's not just technology, it's also, it seems like it's people as well. And Chuck, you probably pay a lot of attention to kind of credit intermediation. How do you think about sort of risk and tolerances and all of that at your firm?
Yeah, I think that it's an important part of our business model in that we do give credit to people who trade with us, and we like to work with them in order for them to trade easier, get better access to the markets. But at the same time, we watch that very closely. We make sure that they have assets on hand, either in crypto or in fiat. And I think that our clients appreciate that because they see that we're being responsible as a trading partner, and it gives them a sense of comfort in terms of trading overall. And I think just building off of that, giving the space a little bit more oversight and credibility will allow some more of the traditional finance entities that are kind of trying to dip their toe in the water and accept the asset class as something that they can really work with their end clients. Because at the end of the day, we'd love to have their balance sheets, in this side of the pool, right? So the more we can do to make them comfortable in the space, the more it'll grow, I think.
Yeah, I would agree. In foreign exchange, actually, we don't take much credit risk at all because everything works through the prime brokerage model. A lack of that, and all of a sudden you become a well-respected counterparty because you've been around for a while. But being conservative has been the best thing we could have been over this period. And then stepping in once it happens and looking at your clients that you've known for a really long time and saying, okay, I'm not just going to strip everything back. I'm going to look at my clients that I've worked with and I understand exactly what they do. Maybe I can do more with them. It's been a business opportunity for us to actually help our clients rather than just go out there with a flat, we're back to zero, no one gets anything. Where do you go from here?
Yeah, to echo that, being conservative was huge for us in this over the past few months because it enabled us to really not be affected by the issues that occurred, but also allowed us to go out to our clients and say, hey, listen, what can we do to help you through this? It was unfortunate that we saw a lot of partners, a lot of players within the market just they're no longer there, but the ones that are still around, we were happy to step in and help them.
So Jenna, you brought up regulation, and I think we certainly can't ignore that. I understand the previous chancellor was more crypto friendly, and now you've had a shift in government. So yeah, maybe starting over again.
No comment.
No comment.
Back to the start.
I can say it, but I think that's one thing that I certainly have noticed is when you talk to institutions, it's not just the local regulator. There are other international regulatory bodies, whether they be the BIS or FCA, as you mentioned, MAS in Singapore. There's influence beyond your own national borders. So how do you think about some of these regulations that are coming? MiCA obviously is gigantic, right? Everything in Europe starts broad, like MiFID. How should we be looking at kind of some of the international regulations in addition to what the SEC may or may not do? Any comments?
I think regulation for us has become a stream in its own right. Like we have a team now looking at where, how, what are we going to do? Are we ready? So MiCA has become a big thing. Where are we going to set up in Europe and be ready for that? I mean, that takes a team, right? In Singapore, for that application, you have to, it's not about saying, oh yeah, we do know someone in Singapore. You have to have a set of, a full team, directors on the ground. But we just need to be ready, and it's only for the best that frameworks pop up everywhere. It would be ideal if they were aligned. We don't know if that's going to happen for a while, but for me, some guidelines around even just Bitcoin and Ethereum would be enough for us to get going. 85% of what we trade is those two cryptos. So something for us to work with would be fine, but just we're all getting ready, I think, and prepared for what's coming on the regulatory front.
Yeah, I mean, I think like the consistency is the ideal. Hopefully they can have consistency across jurisdictions, because otherwise it really is going to fragment liquidity. You're already starting to see certain order books and matching engines have to be separate across geographies, which is again fragmenting liquidity. So I think it's going to have an impact in terms of just like exchanges and pockets of where folks operate and what we consider fungible and not fungible. It's coming though, so everybody kind of knows it's coming. And I think for better or worse, at least regulations take a little bit to play out. So everything will get telegraphed. And then by the time it actually makes its way into proposed rulemaking, it won't be a shock to anybody. So, there'll be time to adapt. But I think things will start to look like a little bit more like the traditional space in terms of specialization and folks having the licenses that they need in order to operate at very specialized parts of the stack or specialized geographies.
Fun? Thoughts?
There's a lot to unpack, right? Again, I have my own thoughts and opinions. I think that the U.S. really needs to take a hard look at how we do things. We seem to just consistently try and put square pegs through round holes and use things like Acts of 33, 34, and 40 to sort of define a new asset class that's inherently global, electronic, seamless, and based on a whole new technology, which is blockchain protocols, right? So what we haven't done is kind of step back and go, okay, look, if we were going to build a regulatory framework from scratch based on this new asset class that most regulators, know nothing about, don't understand the technology, which is not their fault, it's just due to their age most of the time, right? We would come up with a completely different framework. And I'm pretty sure with some 90-something degree % of confidence is that if we took a step back, did a whole bunch of whiteboards, had public comment periods, and came up with a real regulatory framework for crypto, which would obviously inherently have to be global in nature, right? I mean, the irony was that it took, Facebook's Libra coin to actually get the G7 and G20 finance ministers to sit up and go, oh, wait a second, we have to act in concert, right? It's the only thing in digital assets that actually made people sort of wake up. But if we did this properly, right, we could probably have a framework that stocks, bonds, foreign exchange, real estate, and commodities would just slot right in, because we'd have to account for modern day transactions, the inherent globalness, and a lot of things that just, are not applicable to the other asset classes.
Yeah, it's interesting because there's a desire for that greater clarity. There does obviously exist a lot of existing regulations here in the US, of course, at the state level, MTLs. You've also got the bank charters, the trust charters in terms of OCC or different states with different approaches. It seems like even just one topic like qualified custody. Like there's even
You
debate
really
about,
want to ruin my day.
well, I can talk about it because even I'm slightly puzzled about that. But I think overall, greater clarity would be good. But I don't know personally. I can speculate. I don't know if we're going to get everything we're asking for overall. But Chuck, what are you're looking at various things. One thing certainly Greenwich has flagged is the SEC sort of redefining an exchange, what that actually means in the U.S., which is capturing some of the fixed income kind of voice types of trading that are out there, but may actually, in our opinion, grab some of the crypto platforms as well. So how are you thinking about regulation in the U.S. and impacting your business as a broker, as a dealer?
Well, I think the encouraging thing is that from a regulatory standpoint, at least there's some bipartisanship on it. I mean, who would think that these two parties would be able to agree on anything? But at least they're trying, right? But a lot has to be done. I mean, take stablecoins for example. I mean, there's states where we can't do business in stablecoins. There's got to be some kind of clarity and consistency across the board in order for businesses to properly plan and allocate resources and be able to do business. So international regulation is one thing, but we have to get our own house in order first. I think that we were encouraged to see more of it being emphasized because it's going to encourage more of the bigger players to accept the marketplace and come into the sandbox, so to speak, to play. So we're hopeful that we get to the point where we don't have to look from state to state, and see where we can do business, where we can't. I'd rather there be one large umbrella. We were talking about this at a roundtable prior to this, around lunch. And if there's a way to do away with bit licenses and whatnot, and have some kind of clarity as to let's just be able to do business within all 50 states at one time. That would be very helpful to start.
Absolutely. So I know we're getting close to the end, and I think that this is perfect time because regulatory is a bit of a scenario-driven crystal ball question. So I will leave you with the last question, which is take out your crystal ball and make a prediction maybe over the next couple of years, some things that you would expect to see. And you don't have to say it with absolute clarity, but you could say some scenarios you might think around market structure things. For me personally, I expect to see more, Glenn, we talked about the kind of physically moving the asset, not a great thing. I expect to see much more progress at the settlement level. I personally predict that. But Chuck, maybe you can start off with some crystal ball. What do you expect over the coming years?
Way to put me on the spot. Let me see.
Let's get through the ETH merge first.
Okay.
This
All right.
this evening.
Yeah.
And then let's say credit intermediation or credit mechanism in place that should allow for real money to enter.
I think in the immediate, in the immediate future, you're going to see more regulation that's going to really focus on investor protection. Yeah. I think that's going to be top of mind with all of the folks in Washington. It always is. I mean, because you're going to have whoever makes the most noise saying I just put $2,000 in Dogecoin and lost it. What are you going to do about it? That's when the regulators are going to, or that's when the congressmen are going to bring everybody in front in terms of a panel and grill them. So that's going to be top of mind. I think we'll see that sooner rather than later.
Yeah, stablecoin changes and then changes. Yeah, I think those are both good bets.
I was going to say stablecoin regulation. You beat me to it.
That was brought up. Yeah, but go ahead.
Yeah, no, that's what I was stablecoin regulation. I think it's going to come. I mean, the good thing is stablecoins won't go away. So at the settlement layer, they'll continue to be there, but they'll look different. I think the regulators aren't going to forget about what happened with Terra, Luna, UST.
Yeah, I suspect even the word stablecoin will not be used a year from now. There'll be a new term that we'll all be adopting. Glenn?
Look, there's no disagreement, right? Investor protection, and hopefully it is a combination of regulatory oversight that's practical and efficient with people like us on stage building out infrastructure. Again, what people don't realize is that when you do an equity trade, there's probably 6 or 7 safeguards and fire blocks built into the clearing, settlement, and bilateral transfer process. All that has to happen. It's going to be much more efficient and much more seamless because crypto is inherently digital in nature and therefore uses blockchain technology. But I think that's really what we're trying to focus on. And in 2 to 3 years, our job is to make people in this room trade digital assets or even tokenized assets in a way that's extremely familiar to them now.
Perfect way to end. Right on theme. Thank you very much. I really appreciate it. You guys did a great job. Thanks.